Okay, let's dive into this. Welcome to today's Explainer, where we're unpacking what has literally been one of the most chaotic, data-heavy, and just fascinating weeks on Wall Street in recent memory. We are looking at a market that's being violently pushed and pulled by massive macroeconomic crosscurrents, geopolitical tension, and some truly shocking divergences in big tech earnings. So the ultimate question we are trying to answer today is this. Amidst all of this turbulence, has the market finally found a floor?
To figure that out, we're going to walk through the macroeconomic picture, US-China trade tensions, the big tech divergence, hardware versus cloud earnings, and finally, finding the market floor.
Okay, starting with Section 1, the macroeconomic picture. Let's start right at the top with the broader U.S. economy. According to Treasury Secretary Scott Bessent, the top-level outlook is actually really optimistic. Now, you might have noticed the second quarter GDP numbers looked a little noisy, but a lot of that was just a technical adjustment from those massive Strategic Petroleum Reserve oil releases. If you strip that away, core GDP remains incredibly robust. We're talking strong manufacturing, solid job numbers, and a super resilient consumer. The expectation from the Treasury is that we'll end the year well above 2% GDP growth. Plus, the Secretary expects core inflation to fall much more quickly once operations in Iran conclude, noting that energy prices are highly volatile but temporary in their current impact.
But we've got to look a little closer at this inflation narrative, right? Because there's a huge difference between the headlines and what's actually happening on the ground. Headline inflation for June did technically drop, the first time since the pandemic, actually. But prices themselves didn't drop. They just went up a little slower. That headline drop was heavily driven by energy prices, which, as we know, are incredibly volatile. In fact, oil shot up another 10% for July, which wasn't even reflected in that June data. The real barrier to hitting that 2% target is the stickiness of physical goods inflation. Those prices just aren't budging.
Moving on to part 2, U.S.-China trade tensions. Compounding these economic layers are some rapidly escalating geopolitical factors. We're seeing rising friction between U.S. and Chinese trade officials following the recent talks. The U.S. side has issued warnings to China regarding the restricted flow of rare earth minerals, arguing that these measures hurt U.S. businesses and threatening pushback if the restrictions continue. Conversely, the Chinese readout of these calls expresses serious concern over the recent economic and trade restrictions that the U.S. has imposed on China. But perhaps the most striking development from these talks is that U.S. officials presented their Chinese counterparts with what they state is evidence of stolen AI models, specifically pointing to the presence of U.S. watermarks found within Chinese AI technology. It's a tense back and forth for sure, and it's adding significant uncertainty to the global supply chain.
Let's move to Section 3 and see how this builds. The big tech divergence.
91%, wow. This represents Meta's shocking drop in free cash flow in their latest report. They lifted their capital expenditure floor, pouring an absolute fortune into artificial intelligence.
Now, contrast that with 43%. That is Microsoft's massive year-over-year growth in their Azure cloud business.
The market is just violently separating these two strategies right now. Both companies are spending a fortune on AI, right? But Meta's stock dropped 10%. Why? Well, their legacy business model is changing, and they just don't have a clear, immediate return on investment. The market is suddenly demanding to see the cash. Then look at Microsoft. Their stock surged over 15%, which, by the way, is their biggest single-day gain since 2008. Yes, they are also spending heavily on AI, but they are generating a massive ROI through their cloud and enterprise software. They have strong positive cash flow that completely offsets their AI spending. The days of simply throwing money at AI and getting rewarded for it, those are over. The market is now ruthlessly parsing out the winners and losers based on who can actually show an immediate return.
All right, Section 4, hardware versus cloud earnings. This divergence isn't just about software. It is absolutely ripping through the hardware space too. In his final earnings call, Apple CEO Tim Cook used this incredibly evocative phrase. He warned of a 100-year flood in memory chip costs. That perfectly encapsulates the severe supply chain constraints and skyrocketing input costs that are just crippling hardware manufacturers right now. And this brilliantly illustrates the brutal reality between physical hardware and the digital cloud. Let's look at Apple first. Despite a double beat on their earnings, their stock dropped roughly 8%. Wall Street laser-focused on exactly what Tim Cook warned about: hardware sales that are severely hampered by a constrained supply chain, plus some weak services in China results. It's incredibly hard to sell things when you can't even get the components to build them. Now contrast that with Amazon.
Their stocks shot up 14%. Their cloud computing division, AWS, accelerated at 37%, which is its fastest growth since 2021. But more importantly, they posted massive 39% operating margins. When you have margins that high, you can effortlessly fund literally any AI data center build-out you want. It is a tale of two completely different business realities. Which brings us to our final section, finding the market floor. So with all this wild price action, the massive sell-offs, and the stunning tech rallies, we arrive at the ultimate question for investors. Have we hit the bottom? I'm going to borrow a trick from law school here and just give you the conclusion first, and then we'll back it up with the data. The conclusion is yes, it appears we are finding a bottom. Now, let's dive into exactly why analysts believe that. What we've been going through lately is what analysts call a washout. We've seen 4 straight weeks of significant, really painful selling. We saw true AI capitulation, with trading volume in semiconductors just spiking massively. And all of that led to forced liquidations across the board. To put that into perspective, just look at the Korean Kospi index. It plummeted 16% in just 2 days. Why? Entirely because highly leveraged retail traders were forced to reduce their positions. But here's the thing, and this is absolutely crucial. When you get these aggressive, painful washouts, it's actually incredibly healthy for the market mechanics. It clears all that excess leverage out of the system. The forced selling basically wipes the slate clean, and that allows the market to confidently re-engage across multiple sectors and get back to normal. Now, what's really interesting about this data is how the market psychology is undeniably shifting. With over 60% of companies having reported, look at the penalty for missing earnings. Historically, over the last 5 years, if a company missed its top and bottom lines, the stock would get punished with an average drop of 3%. But right now, they're only dropping about 1%. Meanwhile, companies that beat earnings are being rewarded directly in line with historical averages. So what does this tell us? It tells us that the massive fear and aggressive punishment we saw last week is subsiding. The market is becoming much more forgiving, which is a classic textbook sign of a floor being established. So, we've seen the inflation stickiness, the geopolitical tension over tech and trade, and a market that is violently punishing empty AI promises while richly rewarding proven cloud dominance. All the washout indicators suggest the excessive leverage has been flushed and the system is finally resetting. But with a presidential election looming and AI capital expenditures still sitting at historic highs, we have to ask, has the market truly found its solid floor? Or is this just a brief pause before the next big move lower? Thank you so much for joining me on today's Explainer. Keep an eye on those cash flows, and we'll see you next time.